Welcome, everyone. We are very happy to be kicking off several days of great programming here for Consensus at Sibos. And we're starting with one of the most intriguing and foundational topics of the entire week, which is an introduction to decentralized finance and digital assets. And we have a pretty stellar crew here who are going to help guide us through kind of the basics. And to the extent that we have time, we have a tight window here. We're going to get into some of the more juicy topics that are coming up in connection with this area as well. My name is Cecily Mack. I'm going to moderate us. I work with Consensus in solutions and throughout a few other pockets of the company, and really happy to help guide our chat. So I'm going to have you all do your own introductions, starting with Lex, going to Clemens, and then down to Pat.
Wonderful. Thank you so much for having me on this panel. It's a privilege, and it's a really exciting topic that we're going to be talking about. So I'm Lex. I'm the co-head of Consensus Codify. Codify is the blockchain operating system for commerce and finance, and we've just launched last week. So I think many of you have seen our launch and enjoyed the colorful gradients on our website. Previously, I was a fintech entrepreneur for about 6 years, building out a digital wealth platform out of New York. Before that, I had the privilege of going down with a ship at Lehman Brothers and learning a ton from that experience. So I'm happy to draw on that as to why we need new types of financial infrastructure and what it can do for people who are trying to get access to financial products. And then in between there, I spent about 3 years doing deep dive research on blockchain-based financial services and more generally the types of distribution approaches that we're now seeing in the finance industry. So as you know, you get financial products now from your Apple phone and from Amazon and not from the banks that make them. And so I think that's fundamental as to what's happening in DeFi, and we'll try to draw that out through the conversation.
Excellent.
Hi, I'm Clemens Wan. I'm a solution architect for the solutions team. And you bring me in around the third meeting when you speak with different architects and technical parties. I do a lot of the designs, draw a lot of boxes. My expertise is around digital assets, so looking at the crypto space, but also looking at token economics as well as traditional credit, fixed income digital assets. Before joining Consensus for about a year, I was with R3 for 2.5 years, where I built out Corda and Corda Enterprise, building out design patterns for that. And before that, I was with Credit Suisse for 6 years, so building out credit trading applications. And most of my focus within Consensus has been with digital assets, but also with identity and smart cities. So trying to tie all these different groups together, and you have a lot of interesting design patterns that form with token economics, with combining a lot of corporations that are interested in a lot of these separate areas, but want to see a holistic product. So I'm happy to talk about enterprise integrations as well as what conversations we've had with different clients.
Hey everybody, my name is Pat Berardici. I am co-lead of Codify along with Lex. My background is I'm a lawyer coder. I was a computer science math guy in undergrad. Then I practiced law for several years at Sullivan & Cromwell in New York. Did a lot of unwinding of the financial crisis. So I too, like Lex, had a front row seat of kind of, what went wrong, what were some of the big causes, and I think that's been a big. It's definitely one of the things that has informed kind of our view of how we can kind of build a stronger foundation for kind of the next generation of commerce and finance, and how we can build that in and make that easy for people to do with Codify. After Sullivan & Cromwell, I went back to my tech roots. I co-founded a health tech startup for a year. And then I joined Consensus about 2.5 years ago. And like I said, now I'm co-leading Codify with Lex.
Awesome. Thanks, you guys. I find it very interesting that we have as leaders within the company people with both legal and financial and technical backgrounds, because it's reflective of the nature of problems we're trying to solve with this. So before we get into some of the juicier items we hopefully will have time for today, let's start with the basics that the panel really calls for, which is a pair of definitions. What is a digital asset? Clemens, you've been nominated.
Sure. Yeah, so a digital asset is just a representation of any type of token, any type of asset that could be based on ownership. So it's the rights and obligations of the owner of that particular thing. So it could be a digital twin, which is you have a physical asset and you need to see how it's replicated into the digital world. And this representation, and the reason why most people really are interested in shared ledgers and distributed ledgers and blockchain technology, is the reduction of reconciliation for the update of information about the metadata about that asset. So what we're really doing is really having a shared view of that asset and combining all of the changes to it in a shared way. Anything related to cap table management, or it could be a real estate asset. It could be anything related to that. Do you want to?
Yeah. So my explanation, I would say, is much more wishy-washy than what you're talking about. So I think of tokens, which are sort of today's proxy for digital assets, as hyperlinks to the real world, where the hyperlink points to something, that is content, or that is a stack of legal paper, or a set of relationships. And so tokens are just today abstractions that capture all this external complexity. So you could have a year-long process negotiating a deal with all the large investment banks involved, and Sullivan Cromwell and lots of people writing documents, and then instantiating some sort of transaction around a $10 billion real estate project. And the token is really just an abstraction that says, I am a representation of all that stuff in some manner as it applies to some sort of business logic. And I think what happens over time is that more and more of that real world stuff that lives outside the token makes its way into the token. So today is just a hyperlink. Tomorrow, from 1% of the information, we go to 5% of the information. So now the dividends and the governance and the voting of the security that you're referring to becomes software and lives in the token. And then the day after that, when you get to the 10 or the 20%, you start getting the software that used to apply to the thing, right? If you think about rebalancing an asset allocation or a portfolio, if you think about financial planning or some sort of CRM for the investment banker that worked on the deal, all that software that used to be external can continue to bleed into the digital asset. So over time, you're taking this kind of step function closer and closer to all of the things that you used to link to externally starting to congeal into the digital asset itself, which is how you get to decentralized finance and the systems around that. And I think that's why the promise is so interesting. It's not just about, today, let's make this security a little bit more cost effective. It's the destination you get to once you've digitized the assets and the software around it and the networks on which the software used to function, and then the assets in the markets that used to be built around it, and then the participants themselves that function in that market. Once you build that whole value chain, you get to a very different type of financial infrastructure.
And I want to get to some concrete examples of that, but this is a great example of us getting ahead of ourselves because we're building this and distributing this, and I think we do have one more box to check in just the baseline, which is, what is DeFi? Help us out. And I'm going to ask Pat.
Sure. So, I think people use the phrase DeFi to mean a lot of different things. I think on the one hand, DeFi is this idea of having open, permissionless kind of financial protocols on public permissionless blockchains. So, the kind of current incarnation of these are essentially open smart contracts on the Ethereum blockchain that anybody can interact with, and you can effectively take out like collateralized loans. And again, it's open and permissionless. Nobody needs to, go through any particular process to interact with these. So it's that's kind of the kind of pure DeFi. I think at the same time, though, people oftentimes use DeFi to refer to what is possible when you start leveraging blockchain technology, and in particular, kind of open public blockchains to improve current finance, current commerce and finance. There's a whole lot of potential in terms of providing, more secure, more compliant, more reliable financial instruments, which I'm sure we'll talk about. And it's also about kind of being able to access a global, a more global kind of customer base. Because again, these are open and, exist on the blockchain. So I'd say, I think that's the way that I think about DeFi.
Super helpful. And so to bring it to a client level. Let's say we're speaking with a financial institution that is exploring the potential for this technology and advancing some of their own initiatives. I know you do this a lot with clients, Clemens. How do you articulate the advantages and disadvantages of a DeFi approach when you're talking a client through the advisability of this time and money investment?
Yeah, so a lot of what these corporations are interested in is how do they not get disintermediated in this new world where the infrastructure and the technical debt that has been built for the past 35 years, 40 years, and probably even more than that. How do they still find a role of trust inside of a space where it's more or less trust is built into the technology rather than trust built into the governance, rather than trust built into your portfolio manager. And a lot of these services usually hover around the consumer space as a wallet or as custody. So everyone is trying to figure out, is it still possible to run those asset services? So there's pure financial market infrastructure that needs to be rebuilt for the DeFi space, where a lot of the companies are pivoting to take advantage of the new asset value that has been created through mainnet, through ERC20 tokens, through Bitcoin and other types of cryptocurrencies. The advantages that we talk about is first is operational, being able to see that shared ledger, being able to reduce reconciliation. But I think the 10x is about leveraging fractional ownership, leveraging the ability to create lending, being able to create collateral, and being able to lock up collateral on one end while supporting a new asset on the other while it's on the same network. So it's building up networks, but the advantage is you're agreeing on that structure earlier before you create the network, and then more or less create an app store on top of that.
Yeah, and I think it's, I think we also just talk about, leveraging this technology to kind of build better financial instruments and better financial processes and protocols. I mean, and, I think it typically falls in kind of two buckets. I mean, number one, it's efficiency gains. We're seeing in projects we've done in production, saving something between like 30 to 80% oftentimes in terms of doing processes with kind of complex financial instruments. And obviously, that's great for the bottom line. But number two, what it also shows is that you can start to kind of build new financial products that weren't previously feasible, whether for cost or other reasons. And I think that's actually why a lot of financial institutions in particular are interested in this space today, because they can leverage this technology to start opening up new products and new markets for them and their customers.
And back to that number, you said 30 to 80% savings. That's in the transaction costs, presumably, or in middleman costs. What does that actually apply to? What is that of?
It's a general term that can refer to any type of costs that are associated with issuing whatever the financial instrument is. It obviously depends on the use case and what exactly it is, but what we see with this technology is that it is easy to create this financial instrument that out of the box has certain assurances around authenticity, scarcity, and the reliability and auditability that's of certain processes being performed either in the past or in the future. For example, you can say literally this asset cannot trade unless conditions A, B, and C are met. And it literally just cannot transfer unless that happens. And so the kind of the knock-on effect of having, those kind of three out-of-the-box assurances are that they ultimately manifest themselves in making it much easier and much more efficient from a cost perspective to create, issue, and manage these financial instruments that are in this digital form. Mm-hmm. And so sometimes it's transaction costs, sometimes it's just compliance costs, sometimes it's, we don't have to do all of the, we don't have to do as much kind of manual checking around to figure out whether this random PDF is actually, a letter of credit or something. They know what it represents, and it just makes it easier to do business around it.
So naturally, the players who stand to maybe lose some of their utility as a result of these efficiencies want to be co-creators of the ultimate solution.
So I think a lot of people talk about, this technology will, disintermediate and get rid of intermediaries. I mean, I think that will happen to some extent, but I think what a lot of people are recognizing is that I think it really will kind of improve efficiency and competition at the intermediary level. And I think that existing intermediaries, especially in the financial industry, they're not going to go away. They're going to start to be able to do more valuable things for their customers and add more value to the value chain. And I think that's where I think that a lot of them recognize that and are wanting to kind of figure out what that added value they can do. What are those new products or services that they can now offer because this technology makes it that much easier for them to do it?
So I don't know if it's a disagreement or just a rhetorical statement, or just a thing that I will say. But I do think we're maybe not appreciating just how far and how fundamentally we have been changing the world. And I don't mean we in the sense of Codify or Consensus, but generally the blockchain community. So Bitcoin's production level software that's been around for over a decade with 100% uptime and 50 or 60 million addresses that are using it. So there you go for payments rails. Same story can be told around the last 4 years of Ethereum and the software that's run on Ethereum. You can tell the same story about being able to build products like lending products or investment products or banking products, anything that the core banking systems or wealth management platforms or insurance platforms would have really kind of creaked in order to accomplish. All that stuff's been massively brought up to speed in 4 years on what is a very early stage technology. And so today we have fairly complex stuff in DeFi. We have CDOs on DeFi. We have derivatives splicing up interest rates and pulling coupons away from the underlying notional value. We have baskets of tokens that rebalance automatically without any sort of trading software. All of that stuff being built into the network. On top of that, we have hundreds of global banks all implementing data standards for how their internal settlement systems work and stuff that you've worked on. At the same time, you've got now I think 3 or 4 different banks who are coming out and launching essentially internal commercial paper. So internal money markets or internal payments between their different subsidiaries, right? So names like Wells Fargo and Franklin Templeton, not names like Google and Facebook, like Franklin Templeton are launching crypto-based money market funds. And of course, Facebook did a little thing called Libra, trying to steal the world's currency for itself. That's a rhetorical statement. It's obviously not true, but maybe it is. But it's not true. But it's true a little bit. And then you have China, where Baidu has an internal blockchain, and then the entire region of Shenzhen has accounting driving on blockchains, and of course the digital currency that the Chinese PBOC is launching. So I think we're way past sort of this like efficiency cell. I mean, it's nice to say it because people get to have better systems. But the frog has been boiling and boiling, and I think people just don't realize that we live in this world where how finance works has fundamentally and sort of, there's no going back in terms of how it has changed. And so you have on one side things like Revolut and Robinhood and SoFi and giant scalable fintechs that now own millions and millions of young customers, and then on the other side, it is these blockchain-based networks, and especially programmable smart blockchain networks, on which I certainly believe strongly all financial instruments will be built on in the future.
So no doubt that this is happening. I think we would all agree if we're in this room, we have that sense. But what are the either existing or anticipated obstacles to continuing to scale and actually develop in a manner that is going to endure regulatory engagement and oversight? How do you all, whether it's within Consensus or the industry at large, perceive overcoming those obstacles in a long-term sustainable way?
I think a big one is the classification of the type of token and the type of asset that evolves over time. And the way to solve for it, and this is because if you want to regulate those assets, you have to figure out what they do and define that life cycle of that asset. And the base way to do it is likely with a legal infrastructure of some sort. So you can point to a legal document that shows this is how it's going to evolve over time. These are the payments that are going to go through. These are the specific oracles, the types of data feeds that's going to use to trigger those payments. But I think the broader vision around the Enterprise Ethereum Alliance and the Token Taxonomy Initiative is to actually look at the characteristics of those tokens, be able to design it properly, and then be able to issue it on any of the platforms. So that covers the creation of the asset, the design of the asset, and then hopefully how it will be taxed, how it will be regulated, because it's clearly defined as a commodity, a security, or a utility of some sort.
What do you perceive as any prevalent misunderstandings that are out there? I know you just went through a lot of press and launch and interviews and whatnot over the last week or so. What are you finding yourselves having to correct the most in the minds of the curious with regard to DeFi or digital asset? Uh-oh. I don't like it when Lex laughs
Yeah, I know.
before answering a question.
So actually, I don't think we faced very much pushback. People are certainly looking for specifics and is there production level? There's lots of talk around blockchain. Is there anything really in production? So we point to the Comgo example. We point to the tokenization examples that are ongoing. So our team just finished up a 30 million euro tokenization, soon to be 300 million, one day to be 300 trillion, I'm sure. But there are real production examples, and I think people are still under the impression, or they don't have the information that this stuff is real. I think the bigger challenge and the bigger set of misunderstandings is to really think about the incentives of different companies and how they're evaluated. And so prior to Consensus, I spent quite a bit of time on the other side of the table from hedge fund managers and mutual fund managers that invest in public financial services companies. And so when you point out that, for example, the banks historically have had no R&D budget, and all the tech companies do, or if you look at Amazon's R&D budget, it's 30 billion, and all of JP Morgan's fintech commitment was 10 billion over 3 years, and that was them leading the industry by far. So there's some of these structural issues around what finance companies do and why, and I think it boils down to how people invest in finance companies and what they expect. And so this expectation of next quarter's cash flows and sort of playing the political game and making sure the interest rates are this way or that is what prevents the banks from being leaders in this space. And the nice thing has been is that when history is on your side, eventually the types of people that see this as important start getting into positions of power and implementing it. And you can look even at the example of Deutsche Bank recently. In trying to fix their business, the answer was $13 billion investment in technology. So regardless of the content matter of what they're doing, I think that's a massive signal in terms of where the water is going.
Yeah, thank you. So it's 2021, which is 15 blockchain dog years from now. And the three of you are on a panel here at Sibos on a little bit of a look back in the last couple of years in DeFi and digital asset evolution. What's the title of the panel?
I feel like Lex has the title. Come on, Lex.
I think it's going to be something around interoperability and migration of assets across multiple platforms, because what I've been seeing now is you have a lot of prominent tech companies that are partnering with the right consortia that are publishing digital assets into a permission network where all the parties that are controlling it. But there will need to have some growth of a substrate that you can send assets from one to another in order to prevent double spend, in order to actually have that registry of identities so you know who you're sending to. And so once that is established, where all the platforms agree that this is the standards that we're working with, then you can actually start moving across different platforms, and the adoption will be a little bit easier rather than, now people have to choose between which network to join. And I think most of the people on the floor are interviewing each of the networks to say, well, do I want to be a part of this type of platform? Am I betting on one vendor that's doing all the work for it, or do I want to go for something that's a little bit more open, that has connection to mainnet, that has connection to other types of platforms?
And that is officially the longest title of any
yeah.
panel in the history of Sibos, but that was great.
I think there's a good chance we'll see something. It'll be something around like personal and automated finance and things like that. I think the idea that Lex was referring to earlier about we're going to start to see more and more functionality as part of the assets itself. If you think about the kind of added user experience that you have with certain really convenient robo advisors today, I think it's going to be effectively that type of experience kind of on steroids, so to speak, and much more at the asset and individual level than is currently possible. So that a title along those lines wouldn't surprise me.
So, sorry to those who have heard this joke before. So I think the title of the panel would be Terminator, RoboCop, or the Borg. That would be the title. And it's because I think those are the three models that are developing for what finance is evolving towards. So Terminator, you have to visualize. I don't have the slide, but you got to go into like the Schwarzenegger with the half face and the red eye, sort of just to kind of emotionally get you there. It's a joke. It's okay. It's fine. Thank you. So the Terminator model is bottoms-up machine, bottoms-up AI, right? So we know that there are companies out there that are bottoms-up AI, like Amazon, and certainly like all the fintech companies in the East, right? So they are built on a modern chassis because there is no 70s chassis that you have to use. That's an oversimplification, but generally you can imagine these AI-first companies that are building gigantic, mass-optimized financial software because Facebook has all your data or Google has all your data, and they're the best at that bit. So that's number one. And then number two is the RoboCops. So for me, the RoboCop is like a Wells Fargo or JP Morgan. So the sad story of RoboCop is a bunch of limps got cut off and you had to replace them with machines. And this is essentially what is happening with Deutsche Bank and JPM and so on as they replace chunks of the human business, for example, 18,000 people in equities capital markets, with the fintech business, such as launching a robo-advisor on exactly the same day. And then number three is the Borg, which I think, philosophically I'm probably the most aligned to, which is the decentralized finance space where you have this Cambrian explosion of financial primitives that can be integrated, combined, recombined, and then in an open way can be deployed across everybody's phones and financial situations. And so the technology permeates us and we choose which pieces we like to have and which ones we don't.
I like it. And we're at time. You guys, thank you very much. It's great. Thank you all for joining.
Thank you.
Thanks.